Welcome to Opal TV. I'm in Las Vegas at the SALT conference produced by Skybridge Capital. Together with Joe Childrey, he runs the Probabilities Fund. Joe, tell me a bit of your background and what are you doing at the Probabilities Fund?
I started my career at Payne Weber and then spent 10 years at A.G. Edwards, which is now part of Wells Fargo. I started as a retail stockbroker, and I was always fascinated with trend following, what I now know is called pattern recognition. And that led me to memorialize a lot of my thoughts to prepare for the Probabilities Fund strategy. I started the Probabilities Fund in late '07 and launched the actual LP on January 1st, 2008, which in retrospect was a great time to start because we had an up year in 2008. May of 2013, last month, we started our 40 Act Fund, which is a clone of the Probabilities Fund. And remarkably, we called that the Probabilities VIT Fund. Variable Insurance Trust is the VIT.
So what strategy are you following in your funds?
So many people haven't heard of a VIT, a Variable Insurance Trust. This is a 40 Act fund found inside variable annuities, such as the Jefferson National and Security Benefit, which is part of Guggenheim annuity. This allows me to have a 40 Act fund for investors that are concerned about taxes, because there are no capital gains inside the variable annuity. The strategy is essentially trend following. We trade the S&P 500 index. We are either in, out, leveraged, or short. So it's a directional fund. We're not hedging. We're making bets on market.
Joe, when I look at your performance and compare it to your peers, you really stand out. Tell me more about your model. When do you go in? When do you go out? And more about your risk management.
As I said, we trade the S&P 500 index. We're either in, out, or leveraged or short. The secret is I've always been interested in seasonal investing. We've heard of sell in May, go away, things like that. And when you put best 6 months together with the worst 6 months, you end up having a buy and hold. A lot of managers have taken advantage of seasonal investing to be out during what's called the sell in May 6-month period. Very few have studied when to be in, and now with leverage very easily available through ETFs, we studied, my partner Alan Shepard, we studied both when to be out and when to be in. And we found that the market does climb that wall of worry about 65% of the time. And through further studies, we found that, like a lot of things in life, there's an 80-20 rule in the U.S. stock market. 80% of the performance comes from 20% of the days. As you mentioned, our performance, we were up in '08. We've been up every year since we've been managing money. And cumulative, we're up around 130% in our LP, which is a 1.5 and 20 cost structure. We were interested in getting this strategy to the mass affluent in the United States. And the 40 Act Fund made a lot of sense, particularly in the annuity, because of the tax structure. Therefore, we have a clone fund called the Probabilities VIT Fund, which is essentially the same fund, substantially similar. We look at buy and sell signals based on seasonal strategies. Then we pinpoint the entry and exit points using some moving average to get in a little earlier or stay a little later on the buys and sells. Then we look at political and legislative information to tinker with the leverage. That allows us to be either in, out, leveraged, or short.
So you have an LP and a 40 Act fund. Tell me more about your investor base and who is currently interested in buying your funds.
The LP is primarily high net worth investors. We do have a few separate accounts with family office. In the 40 Act fund, we're primarily working with advisors, professional advisors in the United States. Their clients are looking for something that's working, something that's worked the last 5 years, something that was up in '08, something that provides non-correlated alpha. This we are glad to provide. We have a 0.37 correlation to the S&P 500, and yet we're trading the actual index that we compete against. So right now we're working with an insurance company called Jefferson National and a subsidiary of Guggenheim called Security Benefit. Those are the platforms we offer the 40 Act fund.
So you're a alternative investment manager or a hedge fund manager who set up now a 40 Act fund for your strategy. I'm curious, what was your experience doing that, and what's your outlook, your personal outlook on these niche alternative investment strategies within 40 Act funds?
I think everyone's concerned with liquidity, and there's obviously a fee compression thesis going on in our industry. And the 40 Act fund allows us to offer our strategy with daily liquidity and a much lower fee schedule. And it reaches a wider audience. The opportunity to work with professional advisors in the US is something that I'm used to. I like the community, and we're able to work together to offer something that's truly different in their overall portfolio. But with respect to the 40 Act fund arena and where it's going with alternative managers, I don't think it's for everyone. Many managers are using instruments that are not liquid, but for a manager like ourselves, who we're using cash and S&P 500, this is a perfect vehicle to reach the mass affluent, to reach pensioners and 401k plans, etc. So we're able to offer an alternative hedge fund strategy in a mutual fund with daily liquidity and much lower fee schedule than the hedge fund.